Hey everybody, so I'm going to going through some market stuff, some news highlights of the week, but feel free to ask any questions. I actually had a really good live stream with Victor yesterday, and there was so much to talk about, and I felt like we went 2 hours, which is a long live stream. We could have went another 2 hours. It just it's good to have somebody else on the live stream, because sometimes you kind of bounce off each other. So I'm just going to go through some of the things I listed. So the S&P broke 5,800 for the first time ever. So it closed Friday, I think 5,815 it looks. So that's a big milestone, because anytime you own a stock or you own an index like the S&P 500, if you own spiders, I own a lot of spiders, or really anything, when you break through a plateau, it makes it easier for growth on the upside and downside. And you can think of this in your own personal life. I used to run a lot. So if you're a runner, right, and like you could run a mile in 8 minutes, which isn't that fast, but say that's where you're at. And then you practice a lot, and you're like, I'm never going to get to the 7-minute point. But once you break it, then it's like you do it consistently. And psychologically it makes it easier. It's like this, the same thing with the market. Once it breaks through a plateau, 5,800 was a pretty big plateau. 5,900 will be a big one. 6,000 will be huge. Then it seems easier to hit a higher number. But when you don't hit that plateau, like in the runner example, you could spend months running like an 8:05 mile, an 8:10 mile. And it seems like it's never going to happen. But once you do it just once, you don't have to do it like consistently, kind of like if you're a basketball player and you shoot free throws and you want to get 10 in a row. You don't have to get like 10 in a row every single time you shoot. But if you just do it once, that psychological barrier is away, and you know you can do it. Same thing with the S&P 500. So this chart it looks like it goes back to the late 90s, up 700%. And you could see it broke through 4,000. It looks like in 2021. And, that was the first time it broke through 4,000. And then generally the market goes up and down. So do you think the year is going to end at 6,000? Or do you think we're not going to break that barrier? I think there's a chance it hit 6,000. I think there's a pretty good chance with the AI boom. NVIDIA is not slowing down. Microsoft is regressing a lot, which I started the past year. I started kind of late, right? I kind of getting heavy into Microsoft. I kind of have a pretty simple strategy. Like, I generally don't sell a stock unless I really lose faith in a company. But when I buy a stock, I usually spend a lot of time researching that stock. And then, so when I buy it, I have pretty good confidence in it. And the way I do, I usually invest all my dividends, or if I have extra cash, in one stock. So for the past year, anytime I had extra cash or I got dividends from my current stock, I would buy Microsoft. So I built that up a pretty good amount of Microsoft. I did that with Meta for a while, for like a year. Anytime I had extra cash or dividends, I would throw it into Meta. But Microsoft is just one stock. Apple is still the largest company in the world. And companies like that really drag up the S&P 500. And feel free to ask any questions if you want, but I'll just go through my list of things that I wanted to talk about. Okay, election, that's a big deal. Whether it's a Republican or Democrat, it moves the market. Certain stocks go up with a Democrat in the White House. Certain stocks go down with a Democrat. Same thing with a Republican. But pretty much the stock market, anytime there's like a jolt or a shock to it, that's a good thing. it kind of reinvigorates things. So that's why when there's an election, it's generally like a jolt and things change. And it's not like a big deal. Like, it usually doesn't even matter really who's president, but psychologically people think, oh, if we just get a Republican in the White House, then my stock will go through the roof, which doesn't really make any sense. It's really about the company. If they're generating cash flow, revenue, profits, that's why a stock goes up, over time. In the short term, there's a lot of noise. There's a lot of these silly things like insider buying and selling, who's going to be elected, if there's like a war going on. But what matters with any company is profits and how well they're doing as a company. So those external things are kind of like short-term fluctuations. But over time, if you pick good companies, they will grow. Sometimes you have to wait a few years, and it could be a little painful. Let me see if I have any questions. I kind of have the comment section turned off or on a different screen so I can see all my notes here, so I don't forget. Okay. Another thing I want to talk about is cash on the sidelines. Let me put this on the side, get it out of the. Now, I guess I'll leave it here in case I need to reference it. So cash on the sidelines. You might hear that term a lot. And pretty much every term in the market, at one point, we didn't know what it was. Pretty much every term, like, what the hell does that mean? Cash on the sidelines. What is this, like a football game? And they're putting cash on the sidelines? How does that even make sense? But I learned most of the things I've learned over decades of just following this stuff. So, I mean, it pretty much means now it's 6 trillion. I think it's like 6.3 trillion cash on the sideline. So that's just a sum of all the cash in like low yield investments. So savings account, I think the bulk of it is from let me make the font bigger so it's easy to see. So if you sum up all the money we have in our savings accounts, our checking account, CDs, low investment, low yield investments. Even cash, we're getting 0 yield cash in our wallets. That's on the sidelines. Anything that's not invested in a higher yielding investment. Generally, higher yielding is stocks and bonds, even though bonds don't yield that much. But so if you sum up everyone's savings, checking, CDs, and some other lower yield, but those are the main ones, you have 6.3 trillion. And the reason this is an important stat, let's go back to the comments. Gregory, hey Greg, first I want to thank you for your stock reviews. I always watch them. If it's not a secret, how can I see companies whose stocks are you buying? I do a portfolio reveal every 10,000 subs. So I'm getting close to 40,000 subs. So I'll do a portfolio reveal, but you can look at my 30,000 sub portfolio reveal, 20,000, 10,000. I think I did a 1,000 also. JK, good stuff. I need to go now. I'll return later. Okay, yeah, thanks for, but I'm happy to talk about stocks I own anytime you want. But just to stay on topic, and feel free to ask questions on anything, whether it's a topic or not. But if it's off topic, I'll answer it, but I may not answer it in full detail, possibly later. So it's important to know how much cash is on the sidelines, because it's kind of like if you own a business, like you're starting your own company, right? Say you're a dry cleaner, right? And you want to start a dry cleaner in your town, and you have $100,000 in your savings account. So, and you spend $75K just to start the dry cleaner. You have to pay, you have to build out the store. You have to buy materials. You might have to pay first and last month's rent. So you spent a lot of your money just building the business. Now you only have 25K on the sidelines. So it's limited your growth potential, right? You can't really buy another dry cleaner if you're doing really well, unless you save a ton of money. It's hard to scale. Of course, you could take on debt, but that's not sideline money. But if you start a dry cleaner with 300K, right? Now you have 225K on the sidelines after starting that business, and you could use that money to maybe buy another business or grow your own. So that's why it's important to look at, because the more money on the sidelines, the more potential for future growth in the economy. If money was real tight, we didn't have much money, it's hard to stimulate an economy, because how do you grow any economy? It's really, you need jobs. How do you get jobs? You need to encourage people to open up businesses. That's hard to do, right? How do you encourage someone to open a business? Would you please open a business in your town so you could give out 5 jobs to people? The government can start open their own business, kind of, right? The government does it all the time. They have police officers, they have schools. Those are government-run entities, really. Fire departments. So in order to stimulate an economy, the government usually lowers interest rates or injects funds by buying debt. When they buy debt in the open market, they're putting money into the market. So it's a lot of money. I mean, it was under this line is 1 trillion. It was under 1 trillion, probably half a trillion in 1990. It finally hit 1 trillion in 97, but now it's 6x that. So there's a lot of money out there. So these kind of things, you got to look at things not from most people look at things on a micro level, like really, how much am I making? How much money do I have left over after my paycheck? How is my portfolio doing? Even the stock market is somewhat at a micro level, but you have to look at things on a macro level. Like this is a higher level view, and this should give you a little comfort that there's still lots of upside. Our economy is strong. The world economy is strong, and there's no reason the market's going to pull back for an extended period. The market always pulls back 10, 20, 30%, but then after a few months, it comes back. Let me look at comments, make sure. Blade, what's up, buddy? Yeah, it's been a while since I did a live stream. Haven't seen you. Hey, Neil from Netherlands. Thanks for coming on to the stream yesterday. The money aside is good for, it's definitely good for a dip buying opportunity. And money on the sidelines is, people could do whatever they want with their money, right? And I'm sure a lot of the money on the sidelines is not people, the bulk of it is not people like us. Probably 90% of this money is like extremely wealthy people. Because wealthy people, like if there's someone in my community that's worth $25 million that has a $2 million house, he probably the money he has on the sidelines, say, is $1 million, which is a small percentage of his net worth. It's more than all of us neighbors on the block combined. They just have a lot more money. Anything? Yeah, I think so. That should give you a little comfort. Let's see. The average yield of 100 biggest money market funds hit 5.2%. I don't like to leave too much cash on the side. I just have like usually between 10 and 20,000 in my checking account just to cover my day-to-day expenses. And of course, if something arises, like my car breaks down, I have a few thousand if I need it. But I don't like to keep generally more than $20,000 in cash. It usually hovers around 10,000. But people wait too long. I don't know why people are so scared to invest. I see a lot of regular people who just like, my wife is the same. Like my portfolio has grown so much more than my wife's because my wife, she always keeps money, a lot of cash, because she's scared she's going to lose money. And I said, look at my portfolio. Look how much it's up. And sure, I had some big dips here and there, but there's going to be volatility. But I'm in the market since I graduated high school. In the mid 90s, I started investing. I didn't really have much in the market until I hit like 30 years old, till I started making money. I only had maybe $10, $15, $20,000 by the time I was in my mid 20s, because I just didn't have a lot of extra money. And of course, when I graduated college, I wanted to have a car. Let's go back to the comments. See. The money on the side. Okay, I strive to be a $25 million viewer. You will be one day. I'm not close to that. I want to get 10 million. I'm almost like halfway there, I think. Yeah, about halfway, or a little less, like 4 million. But a lot of it is tied up into my house. Okay, so I want to touch on more macro things, but feel free to ask me. You can ask me like specific questions about a stock. Let's talk about the S&P 500. So the S&P 500 is slightly rich, slightly overvalued. So that's another good proxy of the market. You have to look at not just one stock, but all the stocks. The S&P 500 is the 500 biggest, or 500 big U.S. stocks. Oh, this is a different chart. So is the market overvalued? Slightly. Yeah, slightly overvalued. But you don't want to just say the S&P 500 is 5,800. Large caps are trading at the all-time highs. Therefore, the market's overvalued. The same chart. So therefore, it has to be overvalued. It doesn't make sense. You can have, say your net worth is $100,000 in 1980. And now in 2000, your net worth is $1 million. Therefore, you're overvalued because you 10x. No, maybe now in 1980, you were in middle school, so you weren't even making money. Well, no, and then you got to say you just graduated college in 1980, so your net worth was really low, but now you have a high-paying job in the year 2000, your net worth is high. So just because you have to look at it on a PE is a good indicator because it looks at the price. Let me, which you probably know, but I'll just do. Market cap is the P, and E is earnings. You can also, this may be easier to visualize, stock price So the PE measures a company's market cap, which is the value of the company according to the stock market. And we know the stock market is not perfect, so you have to take that into account. Over earnings, so the net income for past 12 months. That's the PE. It's the value of the company, according to the stock market, the market cap, divided by your annual earnings the past 12 months. That's the PE. Or you could just take the stock price. Say you're looking at a stock that's $100 a share, and the earnings per share is $10. So the EPS is 10. Oh, the PE is 10. The EPS changes each quarter. It doesn't change all the time. The stock price is constantly changing, especially when the market's open. So the EPS will stay stagnant until the following quarter, till a company releases earnings. So say EPS $10, and that's when the company released their what's it called? 2Q earnings. That was the most recent as of the end of 6/30. They'll release their third quarter earnings mid-November. But the stock could change a lot. Say there's just some negative news in the market for whatever reason, and the stock goes down to 80. Now the EPS looks a lot more attractive. It's an 8. And the company's fundamentals have not changed because they haven't even released earnings yet. So it's a better value now than it was, say, a month ago. Well, what if the stock goes up a lot after earnings? Now it's a 12 PE, so it's not as attractive because as the stock price goes up, the PE also goes up, and a higher PE indicates the stock is overvalued. Gen Z started investing with GameStop. They take risks. So this is what the PE looks like. This is kind of like the annual PE. So this really high PE was the Great Recession, when things were extremely overvalued. That was in 2008. So this is when you want to run from stocks. Like it's pretty abnormal, right? To break through 100, let alone it's never even broke through 60 before that. This is the average PE for the 500 companies in the S&P 500. And there's usually a big sell-off, right? And then the stock price goes down, it crashes, then earnings adjust because companies were losing money. They were making a lot less money in 2008 for whatever reason. Like Bear Stearns went bankrupt. Business was rough in the Great Recession. That was mainly due to the subprime mortgage crash. But things adjust. This was like I think like almost 2 years it took for the market to come back. I mean, this is the PE, so it's not the market price. But if you look at the price of the S&P 500, I think it took almost 2 years to get back to where it was pre-Great Recession. COVID was a fast turnaround. So if you look now, this says 30. I know they just released that the S&P 500 PE is 21. This might be a few months old. So 21, is that too rich? It doesn't seem that bad, right? Because 20 is right here. And there's been plenty of times the PE was over 20. This is the dot-com crash. It got high. Things were overvalued. And then what happens? People sell off their stocks. Companies go bankrupt. And there's just adjustments. There's acquisitions, things like that. And then things get back to normal. And then there's another bubble. So there's always these bubbles, and then things adjust. So is it 21 PE rich? Maybe a little rich. You could probably find some good stocks. You don't have to invest in the S&P 500. Maybe you could find some good deals. But it's not that bad. It's not like it was right before the dot-com crash, the Great Recession, the Great Depression, when PEs were really, really high. This is a little smoother chart because this is not annual. This just takes like the PE, the past 12 months. So you can see it's a lot smoother as it goes along. And this may give a better indicator of how things are, because the reason it's so kind of volatile is because in this one particular year it was a high PE, and then it came down. But just this takes the average, so that would have been right here. So when you smooth it out, it doesn't even look that bad. It's the same thing as if you were investing. Like, say in January, you say you just look by month. You just look in January, how much money did you make or lose in stock market? You looked at your balance in the beginning of January compared to the end of January, and say you made $12,000. In February, you made $9,000. In March, say there was a crash in March, and you lost $28,000, which wipes out January and February. April, the market's still down. You lose $2,000, but it recovers in May, and you make $40,000 in May. And in June, you made So in 6 months, you had a profit of $38,000. Most of it was in May, but if you look in a chart, it's going to look really crazy. You're going to see this. It starts high, comes down a little, then it shoots way down to the negatives. Then it's a smaller negative, then shoots way up. So you can imagine it in a chart, the spikes in this. But if you looked at your portfolio across, like, on a 6 month chunks or 1 year chunks, it makes it look a lot smoother. But the smaller the time frames, the more volatile it's going to appear. And that's a good way for people to scare the market. If you have a point of view in a market, like you're really bearish on a stock, you could do what's called data mining. You can just pick apart the data and find what makes sense for your story, and then present that to your audience. Or if you're really bullish, you can just pick apart the data and say, did you know in January of 2021, this stock doubled in price? It was $18 a share, then it went up to $35 a share. That jump can occur again this month, but you don't like talk about like surrounding months with the negatives. So it does look a little rich when you smooth it out. It's right here. Yeah, this is current time. So so it does look like it's overvalued, and there's going to be a pullback. Now, you need to look at stocks. You need to look at like those really big, strong companies that are making a lot of money. And are those companies' PEs really poor? And if that's the case, maybe there's going to be a pullback in those stocks. But say you look at it, you could look at even $1 trillion stocks. Say you look at an Apple, and you might say, wow, I don't even know the PE. I'm just saying, just say it was like 80 PE, and you're like, that's pretty overvalued. I don't know if they're going to grow that much. And you look at NVIDIA, and it's 14 PE. So even though they're both $3 trillion companies, NVIDIA in this case, I'm just making up numbers. I don't think this is the case. One appears like a better value. But the market as a whole, it does appear slightly overvalued. I mean, it doesn't look like it will ready for another great recession. let's see, in the 90s, it was like 24, the PE. And there was definitely a pullback, the dot-com crash. But there's always going to be a pullback. And even if the market's overvalued, the only way there's a pullback is if there's a real shock. If there's no real shock to the economy, then it's kind of like Bernie Madoff. Like if nobody, like a lot of people knew he was doing something shady, but until there's like a big shock, there's no reason things will change. He'll just continue paying his 12% annual return to all his shareholders every single year until something extreme happens. So I don't know when that extreme thing will happen. I know the last extreme thing that happened was COVID. That was a huge shock, but we rebounded right away. That was like the shortest recession. Like, what was it, like a month or 2 months maybe? And we got right back to where we were and grew. The Great Recession took a couple of years. So you can see came down, came up. And then the dot-com crash, that took a little time. Let's look at questions. Can you analyze SoFi stock price? I just did a video today. I posted a video on SoFi. Say you have a mortgage with a publicly traded company and their company is performing well. Would it be possible to invest in that company to help offset your mortgage payments? Yeah. I mean, you can invest in the company that holds your mortgage or any company. As long as you get a good return, you can use those funds to pay down your mortgage. But you wouldn't get any special treatment if you invested in JP Morgan and you had a mortgage through Chase. It's not like they would give you money just because you're invested in them. So you have obvious long-term idea because of a false and warranted tax rate. You might have bought Tesla at 400 3 years ago. So I think the market, there's going to be a pullback. There's always going to be a pullback. But the thing is, and this is just a personal opinion, I think our economy is too strong and resilient, and the world economy, lots of countries are really strong, a lot stronger than they were. That's why I don't think we're ever going to have a recession that's long-term, like over a year. I think all the future recessions are going to be short, because it's kind of like, say you have you and your wife and 2 kids. This is like an analogy I'm trying to convey. And say you and your spouse. So if you're a woman, your husband's at home taking care of kids. If you're a man, wife's at home taking kids. So you and your spouse. So you have to, and whoever you are in the video, you're the one who's a breadwinner, right? So say you have a job, you're making $100K a year, and that's sufficient to pay the bills and for things to run smoothly in your household. Where I live, 100,000 wouldn't be good for 4, but because the Bay Area is expensive. And say your savings. This is how I view the past. When like there was a big shock or a recession, it took a long time to rebound. And say you have 25K in savings. So you don't have a ton of savings, but your salary is sufficient to take care of things. And so you're spending like So your monthly expenses and your monthly expense is $7K. So and you could look at this at a higher level. Say this is similar to how the entire U.S. economy is. So you have 3.6 months of expenses in savings. But you don't need to use your savings because your $100,000 salary pays for everything. Your paycheck is used to pay the mortgage and food and things like that. But if you lost your job, things would not be good because you only have 3.6 months to find a new job before things get really tough. Because then you got to start using credit cards. You may have to tap into your IRA. You may have to borrow from family, friends. So this is like the U.S. economy, or any economy that has a recession that So how many months is the recession last? Unless you find a job right away, things are fine. But generally, things aren't that easy. If you lose your job, chances are there's a reason you lost a job. Maybe the economy is tightening and there's a lot of mass layoffs. So your recession, like how much you struggle until things say is 15 months. Because you don't have a lot in savings. But I think now the way we are as an economy, we're so much stronger and healthier. We're making so much more money. So if you're on a flip side, you have a $100,000 salary, same thing, you have $7,000 expenses, but instead of $25,000, maybe say this is your friend. Your friend is also in the same position as you, 2 kids, a spouse, but your friend has $150,000 of savings. So he has nearly, not quite 2 years, 21 months of expenses. So he has a pretty nice runway. So chances are he doesn't even experience much of a recession, maybe a few months. If it takes him it takes him 2 years to find a job. So that's how I feel the economy is now. That's why recessions aren't going to last that long, because we're so much stronger and healthier. If things go awry, if things like fall apart, like there was the COVID thing and there was some prime crisis, then the world ends kind of, unless you're really well capitalized and in good position, just in case something bad happens. So now we're in a good position. I don't know if that hope that makes sense. Have you looked at Dollar General lately? Yeah, Dollar General. I haven't did a video in a while on Dollar General. I'll take a look at it. So China's another topic I thought would be good to talk about. So this red line is S&P 500 since 2005. And the blue line is like China's S&P 500, the 500 large cap Chinese stocks. And you could see the red line, this is the Great Recession right here, 2008. So it did go down, but you can see it's up 400% since 2005. The S&P 500. And then the Chinese index is up 94% since 2005. But if you look at it since 2007, it's down like 50%. I mean, you know this if you own stocks like Alibaba. Lots of Chinese stocks are just doing awful because the Chinese market is really restrictive. I think Xi Jinping is not a capitalist. He's thinking more of like a communist, which is unfortunate, but that's how it is in China. They're very against American companies coming in. They wouldn't, like, there was point they wouldn't allow a Chinese stock to trade in the United States. Like, they try to be real restrictive of stuff like that. And there's no way they would allow American companies to come into their country, set up shop, and do business. They want most countries out, and they just want only Chinese companies and Chinese people to benefit. Where in America, we welcome other countries to come in, spend money, start businesses. Because if a Swiss company came to the United States and had their headquarters here or had warehouses here, and even if they sent everything back to Switzerland, they're supplying jobs. They're employing people here to work. So we don't care. We don't have to keep everything ourselves. So there was I think the Chinese market is up like almost 50% the past month. So you can see this uptick right here. So they're trying to, they're pivoting a little bit. They're trying to be more open to economic growth. They're putting more money into the economy, trying to manage interest rates. So I think this is a good, could be a good opportunity to invest in Chinese stocks. But I totally get it. If you don't want to invest in China, I'm a little weary about investing in China myself. I'd rather just invest in US stocks. It's a much safer. But there could be, I'm just saying, if you're looking for valuation, there could be a big return, a significant return. You could 2, 3, 4, 5x. And it happens all the time. Like when you say this stock, Alibaba, remember, was $80 or $70, and now it's say 2 years from now, say it goes back up to 400 or 500. You're like, oh, I should invest in Alibaba. I could have made so much money. So that's what I'm saying. But you don't know what's going to happen in China. They may change things. Another thing is oil. Oil is up 13% in the past month. Here's the price of a barrel of oil since the 70s. Oil got real high in 2021, 2022. Remember when the price of the gas station was getting close to $10 in some places? At least in California it was. And people going crazy. So that has a huge trickle-down effect on the economy, because when oil prices go up, it costs more money to deliver goods and services. When it costs more money to deliver things, like your supermarket has to get food shipped to them, and they obviously have to pay for the price of the food and products, but they're also paying for the fuel. And if the price of gas doubles, then they're going to have to start charging more money to us to compensate for that. The cost of an airline ticket will go up because airlines' biggest expense is usually fuel. So it has a huge effect on the economy. But you don't want oil prices too low, because then it will kind of shock the oil and gas industry. But we're fortunate as a country because we were so reliant on the Middle East in these time frames. Like anything before like 2010, we were so reliant on the Middle East for oil. Because we run on oil, right? But now we do fracking, and there's a lot of alternative ways to generate oil, and we've taken advantage of that. So we're number one in terms of oil generation, the number one country in the world. And we used to be maybe 8 or 9, and it used to be all Middle Eastern countries were huge, and Russia, of course. So we're less reliant on those countries, which is a big benefit to us. I think we're even exporting oil now. We generate so much. So it's not low. It's around $70 a barrel. So we want to stay, I think south of 80 is a comfortable point. Once you got getting close to the 90s and the hundreds, then things start to get really expensive. But any thoughts on oil? Any thoughts on Respol now that we are transitioning to an electric utility company and FERTs go up? Yeah, Repsol. Yeah, we'll get into that. Let me go through the list. Okay. So interest rates is another interesting topic. So the inverted yield curve is starting to adjust to a regular yield curve, which is great for banks. If you're a bank, so generally, if you buy a 20 or 30 year maturity investment, right, you would expect to get a higher interest rate. So say you invest in a 6-month bond. Come on. So say you every bond is different. So let's just assume it's the same exact bond. And it doesn't matter what the bond is. It could be a U.S. Treasury bond. It could be a railroad bond. But let's say it's the same backing, the same risk profile, because that's what you have to look at. Because you could buy a 6-month bond that yields 1%. You could buy a 6-month bond that yields 20% if it's extremely risky. But same risk profile. So if you buy a 6-month bond, this is a normal way the yield curve works. Let's do years. So a half a year is 6 months. So this is normal. So we'll just call it X bond. So this example, So identical bonds is called X bond. You can think of this as your bank bond. You could buy this bond in your bank. So if you put money into this X bond, say you buy a 1-year maturity X bond, they give you 2%. That means your money's locked away. Let's just call it $1,000 X bonds. Okay, $1,000 X bonds. So if you want to invest in this bond, they offer it at your local bank. It's $1,000. If you don't want your money locked away too long, you'll do the 6-month one. They say you only get 1% yield because it's a smaller time your money is locked up. Like you don't have access to that $1,000 until 6 months from now. And then after 6 months, this is so at the end of investment, this is what the bank gives you, $1,010. If you do the 1 year, you get $1,020. You get a 2% return. So your yield goes up. Let's just make it easier. I think I'm making it confusing. So your money's locked up, but the longer your maturity, like if you want to do the 9-year one, you would get 4.4% per year. So it's not a lot of money. 1,000 times 4.4%. What is that? $44 a year in interest. But which makes sense because that's a higher risk to have money locked away for 9 years. Because in the 1-year example, so that's a normal yield because you would expect okay. But let's say it's like we had an inverted yield curve for 2 years. So say it was the opposite, which seems silly, right? So let me just do the years. I think it's easier to. So if you invest in the X bond, you get a 4.1% if you lock your money away for a year. But if you do 9 years, you only get a 1% return. So why would anybody do 9 years? You just do 1 year, and then when the bond matures, you buy another 1 year, and then when that you just do it that 9 years. Of course, you don't know what the rate's going to be a year from now. So for a long time now, it's finally rebounding. It's coming back. for a long time we had long-term interest rates yielding lower than short-term interest rates. Which really messes up banks, because banks borrow at short-term rates. So we might see a rebound in banks because now the yield curve is coming back. So this is a regular yield curve. This is the interest rate, and this is maturity. So this is a high maturity, like 30 years, and this is a 1-year maturity. So if you do a 1-year maturity, you're going to get a small rate, like that 1% rate. But if you do a 20, 30-year maturity, then your annual yield could be like 5, 6, 7%. That's normal. We had inverted for a long time, but now it's coming back. Now interest rates are starting to normalize. So, and that's why in the past week or two, bank stocks have gone up a lot. I don't know if let me see. What's the banking stock index? What's a good way to look at it? Dow Jones US Banks Index. Oh, the ticker. Let's see if we can. Here we go. Dow Jones. Yahoo Finance seems like they've changed things. Like it used to. I have a hard time looking at it anymore. Well, let's just look at JP Morgan. That's the biggest bank in the world. So I know in the past month, like you can see October 10th, 213, October 11th, 222. So in that one trading day, it went up like 7-8%. So yeah, so banks have reported really good earnings. They usually report early. So and bank stocks have gone up a lot. So that could be another pretty good opportunity, especially if it doesn't invert again. But it was a long time we had an inverted yield curve. So what did you guys think about Tesla? They had I think on Friday, they had a robo-taxi event. And there's a lot of negative sentiment because people didn't feel they provided enough details. I think everybody especially investors, they want to know. They want the CEO to say we're going to be revenue is going to grow 25% this year. They want real hard numbers. They don't want to say there's a lot of tailwinds and we feel the macroeconomic environment, if interest rates get cut 25 basis points, we'll see a lot of forward momentum. Like people don't want to hear stuff like that. It doesn't resonate with them. It's just all words. They want like real hard facts. Like, I mean, this is a real hard fact. Like, it doesn't get more real than this. But you don't have to say revenue will grow 25%. But you could say like, we have a contract with the largest, EV company in Europe, and they're going to buy this, and this over the next 3 years. Or we're seeing sales in this particular vehicle go up a lot due to the, they want to hear stuff like that. They don't want to hear just noise. So at the Robotaxi event, I think a lot of people felt they didn't get any clear answers. Although it's an exciting thing because the ride sharing market, I think 1.5 million miles a year are used in ride shares in the US. And it's expensive because you need a person driving the car. That's a big expense. But if you have robotaxis or autonomous cars, then you eliminate the need to pay that person. And the only thing you need to pay for is the fuel. And of course, the maintenance on the car, but the real expense will be the fuel. And Musk said, he said it would cost 20 cents per mile to operate his autonomous taxis. But if you add taxes, it could be 30, 40 cents per mile. And I think the market is looking for below 50 cents per mile for this to really give them significant growth in the future. I think it's a great idea. Like it's a market that has really been around since cars have been around. The chauffeur taxi market, and it has evolved. It used to be a lot of independent individuals. I remember in New York City when I started working, I think it was called the Medallion. If you had a Medallion taxi, you were like, that was like a game changer. You easily could have made $100K a year just having that Medallion. And you were able to drive people around in New York or the outer boroughs. And a lot of taxi cab drivers were just individuals making money, had their own little business, and they were doing well. Then you have, of course, some companies that would buy these medallions and lease them out to taxi drivers, take a cut. So you'd have companies with like 10, 20, 30, 40, hundreds of drivers in that company. So it's kind of like a real, a little niche, and it has evolved. Uber is the big one, and of course Lyft. So they've changed it a little bit where now people can, instead of having to find rides, they can just sign up to Uber or Lyft, and Uber or Lyft will provide all the rides for them, take a cut of the action. But it's still a really expensive market, and it's not super profitable. It's not a scalable business in terms of when you compare it to something like Google or Meta, because it's expensive. Every single ride needs a person to drive that person around. You could only grow with the amount of people who sign on to your plan, the amount of drivers who become part of your company. The number of rides is kind of scalable. You can probably get as many people looking for drivers, but finding the drivers, it's not simple, and it's not a sticky industry. If you're working for Uber and they're taking too big of a cut, you just go over to Lyft, or there's other ride sharing. So it's not very sticky. Where and I know a lot of people who use both Uber and Lyft. So they're trying to cut. That would be a huge change. And can you tell me what other industries has there been a drastic change? Victor, what's up? I also read about humanoid robots were actually controlled by humans, a scam. EV is a scam. Yeah, I'm not too big on EV. It's really changed the taxi market. Uber really shifted it a lot, and I even think people who were taxi drivers before Uber, I think a lot of them are just now part of Uber, and I think there was a point when a lot of taxi drivers were upset, and they really didn't like the fact that Uber was taking all their business. But I think they've adapted, and I think that's all you can do is adapt. And I don't think it's that bad, because when you're a private taxi company, you do keep all the profits to yourself. Pretty much all the profits. You have to pay for gas, of course, and the maintenance of the car, but you don't have to share your profits with anybody else. But it is harder to find rides. You could go maybe a few hours without having anybody to take for a ride, if you have a limited number of clients. Where if you're Uber or Lyft, you can have a ride constantly. You can constantly be driving someone. As soon as you drive someone somewhere, then you could just go onto either app, pick up a ride. So it's a constant stream of revenue. So I don't think it's really disrupted it that badly. Another market that hasn't really been disrupted is housing. A lot of tech companies have tried to take over the housing process to eliminate brokers and real estate agents, because they usually take, if you have a $250,000 house, you have to pay 6% to the broker. That's a lot of money, 15 grand. Because most people don't have $250,000 to buy a house. They have to take a down payment. They save up many years for a down payment. So say 5 years they saved up $50K for a down payment. I mean, $15K is 30% of your down payment. That's a big chunk. So that's and usually it's split, like 3% goes to the buyer, 3% goes to selling agent. And I know there's a lot of companies who are trying to disrupt this. And who were the housing companies? And nobody's done a good job. Every company, it changed for the better. I hate a taxi service. It did change a lot for the better. I remember getting a taxi when I was younger, in my 20s. New York, if you live in New York City, it's no big deal. But I lived in Staten Island, out of boroughs for a while, and then you call up a company, and they would say yes. Hopefully, they would have a driver available. And sometimes they would be late, or sometimes they wouldn't show up, which can happen. That happens with Uber too, but it doesn't matter. It happens with Uber. It happens all the time with Uber. Once in a while, a driver doesn't want to pick me up, or whatever reason. You wait 5 minutes, and then another driver comes. Like it's never like an issue. Zillow, thank you. Zillow got killed. They got killed. They lost so much money in the housing market. I think they stopped doing it, right? They were buying homes, and they were gonna, clean them up a little bit, then sell them. They lost so much money. I think they almost went bankrupt from it. And there's been a lot of companies who did the same thing, who tried to disrupt the housing market. I don't know if it's going to happen. The car market is much easier to disrupt, because getting a car ride is not much money. It's no big deal. It's very simple. Buying a house is a process, and there's a lot of things that are involved in it. It's not like one or two steps. You pick up somebody in your car and you drive them to the destination. It's not like it's expensive. It's very time consuming. So, and I totally get it. If you're an entrepreneur, I'm sure you're trying, especially if you're a realtor, right? And you have an entrepreneur mindset, you're probably thinking, what can I do to disrupt this industry? Because if you work in an industry, like if you're a nurse, you know how inefficient hospitals are, unless you work at Kaiser, which is extremely efficient and amazing. But if you work at any other hospital network, you know how inefficient the medical industry is. So if you work, if you're a realtor or work in that type of market, you know how inefficient it is, because pretty much everything's inefficient. It's hard to find a business that's like runs so nicely and smoothly, because most businesses are rooted in like people who didn't understand technology, because there was no technology around when the industry started. Neil knows something. Flipping. Yeah, so I think you need a lot of it's like a personal touch. Companies that try to disrupt real estate market. And for a long time, companies have come in and said, we have the best technology, we can do it. And I'm sure in their mind, they had a great process, but it's kind of like when you start a relationship with someone, like in your mind, like say you meet a girl that's really attractive. In your mind, you're like, when you start dating her, you're like, this is the best thing in the world. I'm so happy. She's so attractive, and she seems really cool. And then a few months go by, and you realize she's a bitch, or you realize there's things about her you don't like. And then so it's in your mind. It always seems great, the idea of something, but once you actually try to execute the plan, it falls apart. Shadow Guy, what's up? Yeah, I had a really good time on Victor's stream. It's a lot easier with someone else there, because sometimes you have a hard time. Yeah, it's not bliss. It's not the way it was in the first few months. You can't expect marriage to be like that forever, as long as you could tolerate each other. And yeah, I don't want to shit on marriage or anything like that, but I think everybody knows what I mean. I'm happy with my situation, but I think let me see what else I have in my notes. Okay, yeah. So I think, and because Tesla investors and Tesla analysts have been waiting for Tesla for this robotaxi. Like it's been like years, and Elon has promised it. Elon has said, we're not a car company, we're a tech company. You see the stock went down 9% because the robotaxi meeting didn't turn out well. And there's been a lot of times, the stock hit like 1.1 trillion market cap. It was over $400 a share at the peak. People were waiting for this big change. Like, what's their technology? How are they not a car company? Show us the technology that makes you like a Google, like not just a regular car company. And there were these jumps here when Elon was saying we're getting close to the robotaxi market. So then it's a big buying of the stock, and then people realize nothing's changed, and a few months go by, so there's sell-off. I'm not bearish Tesla. I think it's a great company, but I've said it a long time. They're a $300 billion company, maybe $400 billion if you push it. And you can watch my older videos. I've been saying that for years. They don't belong in a $1 trillion range. I don't think they belong in a $700 billion range, but they're a great company. they're profitable. They're the leader in EVs, but it's still a car company, and cars aren't a highly scalable, efficient business model. It's just a good business, and it's because it's needed. We need cars. I don't think that's going to change in our lifetime. We really need planes too, but there's nothing like before cars. They had horse and buggies. So I guess when you had horse and buggies, you probably said, we need horse and buggies. There's no way for me to get to the supermarket. I can't walk an hour there and back every time I need groceries. I need that horse and buggy. But once cars came out, it made horse and buggies obsolete. What's going to make cars obsolete? I don't think in our lifetime it's going to happen, unless it turns into the Jetsons, where we have flying cars, and that will make regular cars obsolete. But that's not going to happen. I don't think it's ever going to happen. Definitely not in a lifetime. Another thing I want to touch on. Let me just see if any questions on the mother-in-law, or the mother-in-law is a father-in-law. As a car company, they are overvalued. As a robo-taxi and AI robot company, they are really underpriced. Exactly. They are undervalued as an AI company, but they haven't proven it yet. And I think there's opportunity. Am I going to take that ride with you? No pun intended. No, I don't really like car companies, and I don't like, I'm not that bullish Tesla. I don't really, I don't see the value there. And I think EVs are overhyped. Not because I don't have an EV. I might get one, but I just don't see the need for it as much as when computers came out, and people probably thought computers are overhyped. Like mostly in the 80s and early 90s, computers were at only big businesses had computers. And they didn't do much like for personal use. You couldn't but it was good for businesses. But there was no what would I do with a computer? But then people started realizing you can write. It could be good for school papers on computers. They didn't even think about communicating with people at that point on computers. They didn't think of that as an option. But then they started. Oh, you could keep track of things on computers. I guess I could see the value of that. Typewriters are kind of messy, and I make mistakes on typewriters. So I could see computers could be really helpful if my child is in college. But that's my own personal theory on it. I'd rather invest in Toyota or Ford than Tesla. Aren't intrinsic values of the car and AI robotic portion of the company's aren't the intrinsic value of the car and AI portion of the company linked? Well, yeah, of course, when you look at a company, you have to look at a company as a whole. So if you're valuing Tesla, you want to consider the AI potential. And if you're really bullish AI, and you're bullish AI and with Tesla, like the combination of the two, then of course, yeah, it's a great value. But I just don't see it as much. I didn't see NVIDIA either. I didn't see the value in NVIDIA, and I lost out. I do see the value in a lot of companies. I picked up a lot of Netflix when it was down. I'm up almost 100% on that. I got it a couple of years ago. I saw the value of Netflix because I use it. That's part of it. That's not the only reason. I own a lot of stocks. Berkshire Hathaway, I saw the value. I have an iPhone. They own Apple. But yeah, of course, when you value a company, you have to look at say let's simplify it. Future cash flows. So say your friend has a small business, It doesn't matter what the business is. You can pick any business. Say it's a grocery store. It really doesn't matter. And your friend says, I want you to invest $1,000 into my small business. And obviously you want to know, like, what's the return? Like how much do you plan to do in sales this year? Or how much have you done in the past? Okay, so say your friend has said, okay, for my profit for 2023 was $25K. And your friend said, oh, that's pretty good. You made $25,000. And what's my percent of the profit? Like, he said, well, your percent is, I got to do the math here. Say it's 5%. So okay, this is better. Okay. So your friend says you want to be an owner of my company, be an investor. It's only $1,000, and I'm looking for $100,000. So you own 1% of the company, and we had profits last year of 25K. So if we do it again, you get 25K. So I mean, $250. So you're like, oh, that's pretty good, 25% return. So you're happy with that. That's it. I mean, it's not guaranteed. You have to figure out what he does. But say you think it's pretty likely he's going to do 25K again, maybe even more. Did I spell that right? Likelihood? So this is a real simple way to do it. Netflix donated to those demos. What stocks are you looking at in the last few days? So say you do like an analysis of your friend's business. He gives you all the numbers, and he gives you his competitors' numbers. So you do 3 scenarios. I wonder why I figured out a shortcut. If you want to copy the cell above, if I want to copy the cell above me, so I want 1 to be in this cell, you can just press Control D. It brings whatever's on top down. So if I want 1,000 in this cell, I can just, in this cell, Control D. Whatever's above, it brings it down. I used to do go to this cell, copy, go to this cell, paste. But now I can do Control D. Okay. So you're doing a simple analysis on your friend's business. Okay. So scenario one, you think there's a 50% chance he's going to have $25,000 in profit. So this is the only kind of like variable in this equation. Everything else is kind of like a hard number. Because you know your percentage, you know your return because it's a percentage of the profit, and you know your ROI. But in reality, you don't know if he's going to get $25,000 in profit in 2020. Say it's in 2025 you're going to invest. You don't know if 2025 is going to be the same as it was in 2023. So scenario two, you say he might actually have a really bad year. And I think there's a 25% chance he's going to get $15,000 in profit. Now let's do more extreme. Let's say you learn about the business and you're looking at competitors and you're saying there's one customer he has that may move to another company. And if that happens, he's going to lose money. So say there's a 25% chance you think he's going to actually lose $5,000. So your return will be negative $50. So you wouldn't even get any money. In theory, you would have to give another $50, which you're not going to do. But let's just put into the situation. And then there's a 25% chance. So this is like the best case scenario, scenario one. His best year was 25K. Scenario two is the worst case scenario. And then in the middle will be like $20,000. Come on. Okay. So you would sum these three scenarios up. This is the returns in all three scenarios, whether he has a good year, a bad year, or a decent year. And then there's three scenarios. So you divide it by 3 because it's 400, the average divided by 3. So you say, well, the odds are I'm going to get a return of $133. That's your average return for this investment. So if you invested in like, say, 50 companies that are identical to your friend, you would average $133. But of course, you don't know if it's going to be a negative year and you get nothing back, or a good year. But you're saying $133 is probably average. So then you take this over your investment and you say that's a 13% return. And you say, I can live with that. I can live with a 13% return. So you tell your friend, yes, I'll invest $1,000. You're hoping you get a 25% return. That's 50% chance of that happening. But what if after a year ends, right? Your friend tells you, well, actually, I didn't have a $25,000 profit in year one. It was like $12,000 profit. And you're upset because you did this whole analysis based on your friend's information. And you said, what do you mean? You told me you made $25,000 in 2023. Why is it $12,000? Like, where's the $13,000? And then your friend says, well, it was $12,000, but my mother-in-law put $13,000 into the business as an investor. And I summed them up and I thought the business made $25,000, but it didn't. It only made $12,000. This $13,000 shouldn't have been part of the revenue. And if you guys know accounting and have done any like build income statements, you know what I mean? Like sometimes things go into the wrong buckets, especially if you use QuickBooks or those software. If the person who did the bookkeeping didn't put into the right bucket, which is very easy to do. So you said, yeah, I kind of messed up. That $13,000 shouldn't have been part of revenue. I put that into revenue when she gave me the money. It should have went on the balance sheet as equity. And then you're like all pissed off at your friend. You're like, well, if I knew that, and then you redo your model based off of the new information, and you want to look at it, say, well, let me see what the return would have been if I had the right information. So the 50% return should have been a profit of $12,000. And now this changes because the profit's much lower. So this loss would have been $8,000 based on this new information. And then this is not 20, because obviously 12 is the best case scenario. So this might have been 7. So if you look at the 3 scenarios, 50% chance of 12,000, 25% negative 8,000. Now your return is 4%, and you're pissed off at your friend. You're like, I wouldn't have invested if I had the correct information. Why would I put 4%? Money market's 5%. So why take any risk? Okay. So how does that kind of tie into what you were saying? So what you're saying is that if you do an analysis on Tesla, yeah, you have to build in to this, and you might have multiple scenarios, but you have to do a lot of number crunching to come up with this. So so you could do the same thing with owning Tesla. Okay, so say you do an analysis and said, if Tesla, you want to invest 1,000 in Tesla, and you want to see your return. Obviously, you're not going to own 1% of Tesla for 1,000. You could pretend this is much lower. But you say, okay, so what's their profit if everything goes according to plan? The robotaxi thing takes off. They make a lot of money from it. The EV, they sell more cars, things like that. So say this is 12 billion in profit for the year. So you say if everything goes according to plan and it goes perfectly, it's $20 billion of profit. I'm going to do, this would be a more likely situation. You do 25% in the best case scenario. Your base case, the most likely scenario is 50%, and then a worst case scenario. So this is how you would, and then you would look at the base case. So you would look at how the company did last year, just their regular business. And you would assume the robotaxi didn't actually amount to much. They had a small profit, but they did fine in the EVs. So you say if they had 12 billion of profit, like they did last year, and you're assuming nothing was in the robotaxi, that's 50% chance of that happening. And then you do a worst case scenario where you said not only did the robotaxi fail miserably, their car sales also went down, and they were flat for the year, so they had zero profit. So that's how you would do it. If I know I do, my model is just kind of like one number, but if you wanted to look at a company, even if it's a very small chance, AI will make this company huge. You have to build into these scenarios. So say it was it's pretty lopsided, where a company there's a 10% chance of them losing $5 billion. Let me do even. There's a 80% chance of them doing what they did last year, a profit of $12 billion. So in this case scenario, a 5% chance of them doing really well. Your return is 9%, which is okay, but you're taking a risk, of course. There's no guarantee you're going to get 9%. But what if there was a 5% chance they would just go through the roof? It would be $100 billion if this robotaxi thing took off. Even though it's only 5%, look how much it drags up. Hell, look how much it drags up your expected return. So if you looked at it, you would think, I'll put all my money into Tesla because it's a 36% expected return. But if you look at it, there's only 5% chance of this happening, which isn't that great. So chances are you're probably going to get this 12, but you have to build it in. So what's the likelihood of that happening? You obviously can't say it's 90%. So you just have to, that's how you have to kind of approach it. That's any investment. So like, would you invest? It's kind of like gambling in a sense. Would you put your money on this number or this stock if there's only a small percent chance of it happening? Okay, I'll be right back. Yeah, I'll be right back. So I did after on the live stream yesterday with Victor, somebody talked about a stock, AppLovin, which I never heard of before. There's so many stocks out there. It's funny how you don't hear of many. And it looks so appealing because look at their free cash flow in 2021 was $360 million. Now it's $1.4 billion in the trailing 12 months. Revenue went from $2.8 billion to $4 billion. So revenue didn't go up nearly as aggressively as free cash flow. So that's why their free cash flow margin went from 13 to 36, almost tripled. So their revenue is going up, but they're converting such a higher percentage of their revenue, 36%, into free cash flow. Extremely efficient and profitable. Profit almost no profit, pretty much nothing in 21 and 22. Now it's 800 million. So it looked extremely attractive of a stock. And I was really bullish while I was doing the video, but by the end of the video, my bullishness turned into a little bearishness. If you watch the video, you'll know what I mean. I say it's overvalued according to the DCF, but I probably raised the whack. Does anybody know this stock? Do you know why I raised the whack? There's really one reason. Because you could see this chart. I kind of update this chart as I do the video. And what I buy is 8 out of 10. But this is the beginning part of the video. Then I got into their financial statements and I started talking about them. And then I saw the big black hole, a big issue with the company. So I don't think I would buy it. I might short it, but it's a really interesting company because look, free cash flow grew 300% from 2021 to trailing 12 months. Revenue grew modestly. 42% is not that bad for 3 years. It's modest, but it's not that bad. It's beating inflation. It's fine. But that's just crazy free cash flow growth. I love that they buy back shares. Yeah. Let me see. I think I have the. Shit. Let me get the quarterly report. Well, they don't. Let me just get the 10Q. They dilute too. They I could totally see, even if you have basic financial statement analysis skills, I could see why you would think this is a great investment. But if you can dig deeper, I see a big risk with this company. Because look at revenue, 750 million to 1.1 billion, grew like 35%. And look at that. Look at the net income. It went from 80 million to 300 million. So that grew like over 300%. Do you ever notice as you go down the income statement, the growth is more aggressive? Let me show you what I mean. So revenue grew 44%. I'm just comparing second quarter 23 to second quarter 24. operating income grew 198%. And net income so as you go down the income statement, the growth accelerates. For profitable companies, of course. If they're not profitable, nothing's going to help them. So top line revenue is up 44% when you compare second quarter 24 to the same time period prior year. That's a really good growth. It depends what industry you're in, but 20% and above is a really good growth. You want to get at least 10%, because if you're getting, say, single digits, you're kind of bordering on barely growing. Even if 4 or 5% with high inflation, you're not even growing at all. You got to beat inflation at least. Then operating income. So when you minus all the expenses, and their expenses didn't go up that much. This is why the growth is so exaggerated, because when you scale and grow, like past break even, your expenses generally go up at a lower rate because you're covering your fixed costs. Because if you have to pay rent, say you start a small business and your biggest expense is rent, because it's in a popular shopping center. So say you pay $10,000 a month in rent. Once you pay that rent, once you cover it, it doesn't go up the rent. It's not like you have. It's not like you have a. If you have 10,000 in revenue, and your rent is 10,000, all your revenue goes to rent. But if your revenue goes to 100,000, it's still 10,000 of rent. It's not like your rent changed. Certain expenses do go up, like payroll generally goes up as you get bigger, but the growth is not as big. So expenses went up 11% when you compare the two time periods. So that's why their operating income went up 200%, because expenses went up so much more than, revenue went up so much more than expenses. So when that happens, if you flip it, if expenses go up more than revenue, then your margins start to tighten a lot. And if you even go further down the income statement on net income, this has even more expenses, but interest expense went from 50 million to 75 million. So interest expense still went up a lot. It went up 50%. But their net income is up 286%. Who is someone here, the person here who talked about App 11? I can't remember. It was Shadow Guy, right? Shadow Guy was the one who said App 11. So you can see App 11. It IPO'd in 2021. I don't know why the screen left. It IPO'd in April 2021, probably like $20 a share, like most stocks. And then it had a pretty good rise. It hit 103. At the end of 2021, 103. So I'm sure a lot of people bought the stock, because generally people buy the stock when it goes up a lot and they sell the stock when it goes down. People do the opposite. So they were extremely bullish, and it just didn't work out. And the stock went down 90%, over 90%. I think it was like 105 down to like 948. %91 drop from the peak down to here. Now it's trading at its all-time high. But the reason I don't like it is that they have so much debt. I mean, for the size of the company, you can't just look at $3 billion for like Apple is no debt because they have trillions on their balance sheet. But $3.5 billion of debt, that's like 60% of their total assets. They have an enormous amount of debt. And they don't talk about it. And I showed in the video, they don't like, you can't find much information on how they accumulated so much debt, like the interest rate they pay on the debt. So what would I say, 3.5 trillion of debt? $3.5 billion. And I don't think they're getting a great interest rate because they're not that big of a company. So they're probably paying like 6% interest. So 210 million of interest, just the interest on the debt. And the operating cash flow is 847 million. So they do have enough on operating cash flow right now. The hope is that grows operating cash flow, but they're going to have to pay off that debt. So a lot of the cash flow, like nearly half the cash flow or a third of the cash flow, because if they have 518 million, that's about half the cash flow will just go to the interest on their debt. But they have to pay off the debt. So even if they get the 847 million, their entire year of cash flow wouldn't be enough to pay off the debt, which is fine, assuming they can grow their cash flow. I just think it's just a little too much debt. I'm not sure why. And the revenue hasn't grown that much. So that's the only questionable thing with the company. So I don't know. So I think I think for that I think there's going to be a pretty big pullback. I don't know when, but yeah, it's hard to know because a lot of stocks, they have a big run up and then it keeps running up and you're like, oh, I should have bought it, but you don't know when the drop is going to be, if there is a drop. Some stocks just like Nvidia just keep going up. Other stocks, there's a long, like this stock, it ran up, it doubled from IPO, and then it crashed. And then it took a while, it took a few years to get back up to those levels. You know, almost 2 years. I mean, if you got it down here, you're doing great. But even if you got it in January 2022, it was like 28 months to get back up to your cost basis. Let's see if there's any analysts talking about the debt. Yeah, just show you debt to equity ratio is 430%. Their debt is more than 4 times their equity. Equity 800 million, debt of 3.5 billion. App 11 refinanced debt with new 3.5 billion term loans. They give a lot of money to their employees, lots of stock-based compensation. I think it's like $1 billion of stock-based compensation. They bought back stock. See, in just the first half of 2024, they added another $1 billion of debt in the first half. And that $1 billion of debt, they didn't use it to acquire another company. They had to pay down $700 million of debt. And I don't know why they bought back so much stock, but they bought back $750 million of their own stock. And this is the really scary part. When a company gives stock to its employees, they don't pay for that stock because it's their stock. So it's kind of like free money giving their employees stock, but they do have to pay the taxes on it. So just the taxes related to the equity awards, 436 million of taxes. That's a lot of taxes for the size of this company, because 436 million, that's half of their operating cash flow right there, just in taxes to their employees before they ever pay any debt. And the debt was 700 million. So that scares me as an investor. This is great if you're an employee. Well, probably an executive. The employees don't get much from this. If you're like the CFO, CEO, or any executive, this is great because the company's doing well in the market. So you're getting more equity awards, because when the stock price goes up, like if you have stock options, equity options, like say you're a really good CFO at a company, and this company contacts you and says, will you come over to our company? Because we want a great CFO, because you're really good at what you do. And you say, your company's great, but you're not making any money, because a few years ago they weren't making much money. So you can't afford. I'm already making $250,000 at my current job. I don't want to go for. I don't want to take a cut in salaries. So what this company does is saying, we're going to give you $150,000, but we'll give you stock options. We'll give you 500,000 stock options. And the way stock options usually work is either they invest over a number of years, or if the stock hits a certain level, then the options are exercised. Because if you're given options in a company, or you buy options, like you're long, you want the stock to go up. It doesn't make sense. You want the stock to go down. So if the stock goes down in price like it did in 22, none of the options are exercising. Everybody's just sitting and waiting. But once the stock is going up a lot now, then all the options So when you took on the job, you said, well, your stock price is 25 a share. So they give you options at $50 a share, because that's generally how it works. If the stock goes up, you're rewarded. The stock is just going through the roof, and that's where a lot of the money's going, to the employees, because all these options are exercising. Because you promise so many people stock options, and you're like, you probably thought, well, the stock has never, it hit 100 once, right after we IPO'd, and say you're right here, it's like 30 or something. So you give all these options at 100, saying it's probably not going to hit 100 anyway, and then it crushes 100. So that's why they're, when people get stock, it doesn't cost the company any money, because the stock is free for them. But like I said, they have to pay taxes on it, and it dilutes shareholders. So that's why they bought back so much stock, because the dilution would be so aggressive that the market would turn on the company, saying, why are you issuing so much stock? And they're not. It's just the employees are getting it. Does that make sense? So I don't want to scare anybody saying it's a terrible investment, but I would be a little weary, because that's not a good use of funds, to give stock to your employees and pay all these taxes. It's fine if you're making billions of dollars, like a Google is, to give a lot of stocks options. But when you're just becoming profitable and you have $3 billion of debt, which is 60% of your assets, it's a little risky. And you could let me know if I'm wrong, but that's just how I see it. And if you want to look at how well the company's doing historically, because obviously they're profitable right now, but historically they're losing money. Accumulated deficit, that's a sum of all their prior net income. So they're still in the red as a company. Sure, right now, this quarter, they had profits, but who cares? Like, if you invested in a company, like if you had a business, like if you put 100K into a business, in the first year, so the first year you lose $25,000. It's the first year, so it's always hard to make a profit. Second year you break even. Things are improving. Third year you have $35,000 of profit. So if your friend said, "Wow, you have $35,000 in 1 year, that's great," you're like, "Yeah, I'm happy. It's profitable, but I'm still in the red. I'm still losing money." Even if year two you have 90,000, let's do like 70,000. You double, you're still in the red. So it's not like you're killing it. You want to become a profitable, healthy company. So they're not at that point. That's just my 2 cents. Are they not too self-confident in the company to take debt to buy stock back? Well, they had to take debt. I mean, there's nothing they could have done, because they don't have enough cash flow to fund, because they're not growing. They're not. They might be doing some acquisitions, but most of if they did, it would be right here in this section. And they spent 15 million on acquisitions, so some money on acquisitions, but all the money they generated, they can't even cover. They have to do these two. They have to pay the debt, because the debt's due, so they have to pay it back, 677 million, and they have to pay the taxes on the equity awards. They could get, if you don't pay back your debt, you're forced into bankruptcy. If you don't pay the equity, the IRS will come after you, the taxes on it. So they just have to pay that, and that's 1.1 billion right there. Yeah, 1.1 billion. So they added 1.1 billion of debt, which makes a lot of sense to me. But I don't know why they bought back so much stock. The only reason I could think of is that they did so much dilution because their stock price went up a lot. So that means they had to give all this stock to their employees. So the bad thing about giving stock to your employees, it dilutes the shareholders. It just adds more stocks into the open market, more shares. They must have had I want to see how much cash they had. So they did have a lot of cash, a decent amount. They had 500 million of cash at the end of 23 and 460 million of cash. So they do have a lot of, they have some cash on the balance sheet. So I guess that's how they came up with buying back so much stock. But they didn't really need the cash on the balance sheet, because they pretty much used the entire 847 million, or most of it, and bought back all that stock, which they shouldn't have done, but it's market perception. Because if they're paying 436 million in taxes, that means that's like 2 billion of stock they gave to their employees. Because so 400. So 436 million. Jeez. So say they pay 25% in taxes, because that's all we know is the taxes they paid on the stock. That means they gave their employees 1.7 billion of stock. And I can't find this information anywhere, but I'm just backing into it. 1.7 billion of stock. And what's their market cap? $49 billion. So it's I think I mentioned this in the video. So that's 4%. So that means they gave their employees 4% of the company. That's a good amount of dilution. Imagine your investment. If you had a 10% return, you have to minus 4% because of dilution. So now you're down to 6%. So they diluted you 4%. I just stepped away for a few minutes. And which company is that? AppLovin? And historically, they're not profitable at all, but maybe this is how companies do it in the early years. Maybe they give so much stock to their employees. It seems a little too much to me, but so so they just mention, yeah, they don't really give too much details. Here we go. The statement of changes in owner's equity. They issued 4 million shares of stock. So they issued 4 million shares, and it's $147 a share. So $580 million of stock. It had to be more than 500 million because they paid almost that amount in taxes. Maybe, I guess they issued, okay, that was just for 2023. Okay, you see this, who looks at the statement of changes known as equity? Finally, I have a reason to look at the statement of changes known as equity. Usually we hardly ever look at it. This is like, I think, almost the first time. So in December 2023, they issued I mean, I looked at it before, but I never really had a reason to look at it. I just kind of like talked about it. Okay, just in the first quarter of 2024, well, this is the balance. This is app 11. Is everybody following? Is this too kind of like getting too involved? So just in the second quarter alone, they added 5.5 million shares. They did give 3.9 million shares to the employees up through March 31st, 2024. So since they started as a business, they've given employees almost 4 million shares. They added 5.5 million just in this quarter alone. So the value of the equity given to their employees what did I say? I said 1.7 billion. I should have used a higher tax rate. I had a feeling if I used the correct tax rate, 33%, it would be 1.3 billion. I would have been like, almost exactly. We're 1.321 billion. This is 1.321 billion. I gave them benefit of the doubt, but okay, so they gave their employees 1.3 billion of stock up through June, up through current times, and they had to pay 436 million in taxes on that stock. This is the kind of thing, if the company, like, say, went into default, went bankrupt, and people would say, like, how could they go bankrupt? Like, they a 49 billion market cap company, and they were growing. They grew a few 100% the past year. How could they go bankrupt? Like, they're making so much money. And then an analyst would say, well, it was right in front of your eyes. Look at the debt. Look at how much they've been giving their employees. They couldn't, there's no way they can maintain that. But this is all theory, of course, because they might generate a lot more cash flow. I don't know. And I don't think anybody's talking about this because it's not like a common thing you would talk about. But something to look at, because we know that, so 9.5 million shares went to their employees. What do you think the employees did? They sold it all. Look at the sales, insider sales. 200,000, that's CEO. 200,000, 100,000, 3.9 million, 389,000. The CEO probably has a lot of shares, but Vasily Shikin, he's a chief technology officer, right? He started in January 2020. So they offered him probably a nice package. Come to our company. We'll give you this really nice equity plan. And if the company stock goes up, you'll be a millionaire. If stock goes down, then at least you get your $200,000 or whatever. Let's see what he makes, his salary. Does anybody find this interesting? I find it interesting, but I don't know if anybody else does. And I don't blame Vasily, because I would do exactly what he did. But I'm just showing you how it works. Here's Vasily. 67 million of compensation. But that's not what I was trying to find. I want to find his salary. So I'll show you how like it's kind of meaningless, his salary. Okay, well, he had a good salary. I mean, it wasn't like millions, but 400,000 is a good salary. I thought it was going to be lower. Okay, so Vasily's salary, that's a good job, right? $400,000, but it's not like life-changing. For a lot of us, it would help us a lot, but it's not like you could retire, especially if you have kids and a family. You can't retire on $400,000. But you could retire, and we know how much money he made because he got the stock for free, so he didn't spend any money. He was given the stock for coming to the company. So it says right here, 389,000 shares. He even sold it when it was $39 a share. He didn't even wait for it to hit 100. Like, I mean, if he waited to 100, he would be killing it. But he didn't even. But even at a low point, like pretty low point, he made almost $15 million selling stock. And I would do the same thing, because if I was Vasily and I had a good job, right? And he was probably given the stock. If he sold it at 39, I mean, we could figure it out, actually. Okay. It had 400,000 base salary, 67 million in stock value. That's what his stock is worth, not what he sold it for. Because obviously he didn't wait. He sold it at 38 or something. So if he waited, it would have been 67 million. It 4x'd since he sold it. But he's probably fine with $13 million. Well, I want to see, when did he become part of the company? Okay. So in January 2020, he was hired. So when he was hired, that's probably when he was given the stock options, around when he was hired. Well, the company was not public, so he's probably given stock options before it went public. So there was really no price point. So when did he sell it? He sold almost 400,000 shares in December 2023, and a month before that, he sold 300,000 shares. So he probably sold all his stock in the company, which he could do, I guess, right? But he didn't even. He sold in December 2023, right before it took off. I wonder if he's upset. So when he got the stock in a company, it wasn't even traded. It was pre-IPO. So there was no like, so he waited till the end of 2023. So the reason he waited, because when you're given stock options, is generally you can't sell it like as soon as they IPO. Usually you have to wait a certain amount of time for a number of reasons, but it doesn't look good if as soon as a company IPOs, all the executives sell all their stock. It would look weird, right? So he probably had to wait like a year or something. And then the stock went to 100 after a few months, but he was still locked up. He had a lockup period, so he couldn't sell it. And then it went under $10. So he's probably like, oh God, imagine I could have sold it at 100. And then it finally comes back up. It takes a bit. and it's only trading at 39 at the end of 2023. So he's like, okay, finally it's come back to a little more than the IPO price. Say IPO was 16, so it's double IPO. So he's probably like, I'm going to take my $25 million. So that's pretty much what happened. I mean, who could have, if he knew it was going to hit 150, he wouldn't have sold it. But who wouldn't do that if you were like working for 20 years and you had a good job, you're making good money, but you weren't like, you always hear about people who have like, tens of millions, hundreds of millions, but you weren't even close to that. Because even if you make $400,000 after taxes, after paying for things, it's maybe you could save 100,000. Probably not even that much, but maybe you could have $100,000 in savings. So after a decade, you grow to $1 million. But who could blame him, right? I wouldn't. I'd do the same thing. So the insider selling is which doesn't give you much faith in the company. You can see number of shares sold by insiders, almost 3 million shares in the past 3 months, 87 million in the past year. The buys are kind of high too, but I think the buys are not from employees buying stock. It's just they were given stock and they sold more than they were given. So they pretty much, in the past year, you can think of it, you gave all your employees, mostly the executives though, 69 million shares, and they sold them all. Not only did they sell all the shares you gave them, they sold shares from prior years because they sold more than they were given. But I wouldn't say this is not a good investment because of insider activity. Because insider activity, I don't really think matters much. I think the reason I'd be scared is because of the debt. They have way too much debt, and plus they have to pay all these taxes. So it just adds a lot of dilution, and they have to. But you'll see the video. It's a long video. Is there any other stocks, or are we good? Any well, let me look at like what else. Oh, this is what I think was really interesting. This makes me even more bullish on Amazon. Kuiper. Has anybody followed this? Amazon has Kuiper, spelled Kuipr, wireless broadband. Do you feel comfortable holding ET if Harris wins? Yeah, I mean, I feel fine with ET. I just look at really the fundamentals of the company. I'm not too concerned about it. There will be certain industries will shift a lot right after the election, but like cannabis stocks went through the roof when Biden got elected, and then if you look a year later, they all crashed. because you still need to be profitable. What's the biggest cannabis stock? Yeah, Aurora. ACB. You can't even look at it. It's crazy, right? Look how much. Okay. In 2020, every leap year there's an election, right? So in 2020 was the last election. I mean, a president gets elected in November. Like, he got elected in November 2020, but he didn't actually take office until, is it February 2021? But anyways, so when he got elected, Biden, at the end of 2020, you can see this is all cannabis stocks, but this was trading at $87, and it hit almost 200. So within 3-4 months of Biden getting elected, cannabis stocks more than doubled. And that's the peak. You can see that's the total peak, 189. And now it's down to $5. So that's just how it is. There will be lots of surges in certain industries, but the companies need to be profitable. It's just news, right? I was looking at Pfizer, but I don't know if I want to take that leap. I really like CrowdStrike. I've always looked at CrowdStrike. But here's a reason why Amazon could become the biggest company in the world with stuff like this. Kuiper has anybody been following this? So Kuiper Wireless, it's Amazon's own wireless broadband, and it's really there's a lot of communities. You don't realize how many communities, even in the United States, don't have really good access to the internet. So it's hard for them to order things like from Amazon. Amazon is the largest retailer in the world. Well, Walmart kind of is the largest, but Amazon's going to take them over. So in order for Amazon to get more sales, they need people to access computers, right? Because if you don't have access to computers, how do you get groceries and medical supplies? You drive. You drive to the store. You drive to Walmart. You drive to the supermarket. You pick it up. You drive home. But if the internet connection is pretty limited, you're probably not going to rely on that. So Kuiper is giving access to communities, well, everybody, even in big cities, but it's really focused on those rural, small communities so they can get better access. And of course, Amazon has Amazon Web Services. So that's a big benefit to them as well, because if more people have internet access, fast internet access, they can use all these sites that are built on AWS. So how do people do it now? How do people, it's easy if you live in a big city or even in a normal city, internet access is pretty easy, right? You go to Xfinity, Comcast, AT&T, and you get online. But it's spotty in a lot of places. Right now, the way people who are in small towns get on internet, SpaceX has Starlink. So all the way up in space, SpaceX was set up this infrastructure so all these smaller areas can get access. But apparently Kuiper, Amazon's, is faster and better and more reliable. T-Mobile has a lot of coverage too. Yeah, a lot of companies have a ton of coverage. So read up on it, but it's real exciting. It's big. It's a big deal, real big deal, because if you can get like 10% of the United States on high-speed internet, and then you get a lot of the non-US people outside the US, it's even harder for them to get good internet access. Unless you're in, if you live in Mexico City, it's easy. But if you live in a lot of other towns and smaller towns in Mexico, it's probably almost impossible. So Project Kuiper is Amazon's initiative to provide fast, affordable broadband communities all over the world, especially underserved communities. So it's a big deal when you can control data. And that's kind of like the link, the key to getting online. Now, when you have a company like Apple is just such a massive company. And that's how I get online a lot. I use my iPhone. I could use my computer too, but a lot of people are using iPhones. But without internet access, I couldn't even use my phone. So in order to sell more iPhones, I would need to live in a place that had really good internet access. So Project Kuiper, to achieve the goal, Amazon will deploy thousands of satellites to low Earth orbit, linked to a global network of antennas, fiber, and internet connection points on the ground. So they have to go way up in space and connect them to things on the ground, the infrastructure on the ground. Who will Project Kuiper? What kind of question is that? Who will Project Kuiper help connect? What, a third grader wrote that? Who will Project Kuiper? Oh, I think that. Who will Project Kuiper help connect? So billions of people around the world don't have reliable access to broadband. Poor connectivity means limited access to modern communications, healthcare, etc. The network will also serve a wide range of customers, including schools, hospitals, businesses. So it's going to be all around the world, Project Kuiper. So, why is Amazon doing this? So you don't have to travel far for major cities to lose internet connectivity. It can happen within a 60-minute drive from Amazon's headquarters. That's true, because if I'm driving somewhere and I lose internet connection and I don't know my way around the area, it's a nightmare. And there are places you do lose it, and it's painful. So satellite broadband will fill in those gaps. Project Kuiper is used in the same devices as a Kindle, Echo, Fire TV. Blue Origin. I don't know if you guys are familiar with Bezos' Blue Origin. That's just a space company. Bezos is trying to compete with Musk. So it's not part of Blue Origin, the rocket company. It's its own separate thing. Because high-speed cable is really competitive, because there's a few companies that really control it, right? I mean, there's a lot of small companies that are trying to compete, but a few companies really control that market, and it's a big market. It's so expensive because you have to lay down. Okay, I think I lost connection. Isn't that funny? Because I'm talking about internet connection, how important it is, and I just lost connection. T-Mobile has a lot of companies are trying to expand to Mexico. Any potential there? No, that's what I'm saying. If this goes well, Kuiper, Mexico is like ideal. Like it's like, I mean, a lot of countries are a good candidate, but we're so close to Mexico. It's a lot easier to grow in a country that's right next to you. It's less fuel, less planes to get from one point to another, because they do have to lay down a lot of infrastructure in that city. It's not just all in space. They have to put like this in order to connect from space to the ground. They have to have the satellites on the ground as well. So Project Kuiper is a long-term initiative. Our FCC license requires that we deploy and operate at least half of our satellites by 2026. So a little less than 2 years, but that's not far off. A little less than 2 years, because even a year from now, they might have some of it built already. I think this is really exciting, because when somebody talks about robotaxi for Tesla, it's exciting, but it's not likely to happen because they've been talking about it so long, and it's just such a far off thing. Like it might not happen. There's a decent chance it might not happen, but this seems like a good possibility. So, and Tesla, I mean, Amazon, it was really high in 2021, and then it took a big dip. And now it's finally at its all-time high, but it's not really like if you look at like Apple, Microsoft, Meta, they're off the charts, way past all-time high. So Amazon is not much higher than its 2021 levels. So there's potential there. Then robotaxi, and there's a timestamp by July 2026, because robotaxi, it's never happened, so it's a brand new industry. Satellites, internet connection has been around a long time. Even like SpaceX currently, like I said, controls Starlink. So they're doing that already. Just Amazon wants to kind of upgrade Starlink. So we expect to begin deploying our satellite in early 2025. Project Kuiper started off as an internal code program. The name refers to Kuiper Belt. So they have 2,000 engineers on a project. So, okay, it has three parts: ground infrastructure, satellites, and customer terminals. Amazon's ground infrastructure includes gateway antennas that securely send and receive customer data to and from satellites. So that's on the ground. So a lot of antennas. So each country they go in, they have to put these antennas in those countries, in addition to the satellites in the sky, in space. But they control the cloud. They're the number one in cloud computing. So it's not like when Apple started to develop the EV and they scrapped that idea. Apple building an electric vehicle was so different than what Apple was doing already. But it's kind of like ties into like what Amazon's business is already. Because when Amazon started just selling an e-commerce business, they started just selling books online. Then they expanded and sold everything. Then they did cloud computing, which was totally different. But they're really successful in cloud computing. So Project Kuiper includes 3,200 satellites. How do satellites get into space? Amazon will, with commercial launch providers, we've secured 80 heavy lift launches with commercial launch providers. So they use companies, they use SpaceX, and of course they use Blue Origin, which is their company. So they're probably going to use Blue Origin more. Because when Blue Origin started in SpaceX, I didn't see much demand for people going to space. Like, how many people need to go to space? Maybe if you're really rich. But now I see a reason to use Blue Origin for stuff like this. Is it safe to have so many satellites in space? How fast will Kuiper Internet be? We're trying to design the system to balance performance and affordability. So it's going to be really fast, the internet, once this gets... Amazon hasn't announced pricing details yet. There's a bottleneck in computing power. Well, I think every industry, when an industry is growing fast, like AI is really growing fast. Like when cars were developed, right? When people started making cars and driving cars, there was lots of bottlenecks. There was bottlenecks in terms of steel or different materials that are used in cars. But you kind of you figure it out. You either, like, we'll use that example. When people started driving cars, the demand was through the roof because more cars. So so steel was and rubber for the tires. So those are bottlenecks, right? So just more companies start making this stuff. Or if there's not enough companies making rubber you start making rubber, your company. You just find a way around it. I mean, with the markets at highs, I'm concerned where you buy any company, you must use a chart. Anything can happen to get a small correction. If you're a trader, short-term trader, yeah, I guess. But if you're long-term, I don't see a reason. Just pick a good company. If you're holding long-term, like if you hold a stock 20 years, if you look at any 20-year time period for really good companies, you're probably going to make a lot of money. But I mean, I don't see, and there's plenty of companies that are still valued appropriately. Like, I wonder what their ratios are. And they're a big company, $2 trillion. So, yeah. So they were a 79 PE in 2019. They were 246 in 2023. Now they're 45 PE. So it seems a little overvalued, right? But if a company has a high PE, that indicates they're going to be growing a lot. So if they don't grow a lot, like if Kuiper doesn't work out as well, and if their other cloud computing doesn't grow as much as expected, sure, the PE may stay high. But yeah, it's you can look at individual companies and try to find good deals. Okay, it's been a long stream, almost 3 hours. Yeah, I bet SpaceX could launch Kuiper for Amazon. Blue Origin only does tourism so far. Well, Blue Origin is going to be working a lot with Kuiper, at least what they say. Yeah, thanks for joining. Try to watch the videos, and I'll try to do more streaming. I kind of fell off for like a month, but okay, talk to you later.